to this week's Manager's Thoughts, coming to you from Kelly at Synergy Asset Management. It is November 18th, 2022, and we're super excited to give you guys just an update of where the markets are and where economic news is this week. Alrighty, so jumping right into it, this week the focus was on producers and retailers with the PPI, the retail sales, and a few earnings calls from major retailers being released. And so as of Thursday, November 17th, the S&P 500 and the NASDAQ were about flat at 0.2% down for the week for the S&P and 0.5% down for the NASDAQ. The 10-year U.S. Treasury yield fell about 2.3% for the week, and really interesting point, the 10-year to 2-year U.S. Treasury spread in the yield increased 27% this week. So really significant. We'll get more into that in the next slide. Overall, you can see that we are in kind of this uptick here in all three of these major indices, but overall still in this definite downtrend. So when are we going to see reversal in this downtrend? We're not sure, but it's still really important to look at the big picture of markets before making any guesses, as well as some of these data points that we're going to get into moving on in this PowerPoint. So like I said, the 10 to 2-year U.S. Treasury yield spread increased 27.5% this week. This was actually the biggest increase in spread since the 1980s. And you can see in the chart here, just 1 year ago, we had a normal yield curve. But even just in the last month, you can see the blue line was just 1 month ago, and the red line was just mid-month this week. And so we're definitely in that inverted yield curve stage. Typically, this is an indicator of a recession to come. Definitely not certain, but just a really interesting data point that we're keeping an eye on and monitoring for you guys. On Tuesday, the U.S. Bureau of Labor Statistics released October's Producer Price Index, came in at an increase of 8% year over year from last October, below expectations of 8.3%. So this really echoed the October CPI data, and month over month, it was only an increase of 0.2% from September, and this was much lower than estimates of 0.5%. And so here you can see on the chart, the services index is much lower than the total index, and the goods index is way higher than either of those two. And so overall, services are helping to contribute to this decline, but also you can see the sharp decline in good prices here. That's also been helping kind of bring down inflation to producers as well. We also got retail sales data this week, which indicated, excluding auto, month-over-month growth from September to October of 1.3%. So estimates were 0.5% growth. This was 160% more than the estimates. So adjusted for the 0.4% inflation rate in the same period month over month, consumers still spent plus 0.9%, or almost a whole percentage point more in October than they did in September, which is pretty significant given the current economic environment. In October, though, the really interesting thing here you can see is that general merchandise has gone down actually in sales. So overall, this is really interesting. You can see how it was positive these few months here before, and we'll be getting into a little bit of why the general merchandise category might have decreased in the next slide. This week, we got a lot of retail earnings data. So two of the largest retailers, Walmart and Target, announced earnings this week. Walmart beat their estimates by about 14%. Target missed their EPS estimates by about 29%. So you can see the lack of customer demand for these discretionary items, as was seen in the last slide, that general merchandise sales was actually falling for the month of October. So that's definitely seen in Target's lackluster earnings as well. Target tends to attract those more higher income customer base, so maybe these individuals might be a little bit more concerned about the state of the economy. Maybe they are pulling back on their spending, increasing their savings as they see a few economic indicators not look so great. Walmart, you can see year to date, has performed exceptionally well. They're up about 2.4%, especially after this last earnings pop. Target, on the other hand, is down over 30% year to date. So these two retailers, very important to the economy, very telling about what consumers are focused on. So a few other retailers announced earnings this week. TJ Maxx and Ross both had excellent earnings, as again, shoppers are looking for deals, they're looking for a good value, and they're looking for things that they need. So that includes clothing, necessities, that sorts of things. Very interesting to see. So this week, another update in the tech layoff space. Amazon actually laid off about 10,000 employees, primarily in its devices and services division, working with Alexa products. Following this announcement, the CEO, Andy Jassy, warned his employees in a corporate memo there will be more role reductions going into 2023. So this adds to the already 120,000 white-collar tech layoffs so far in 2022, which will almost certainly continue through the new year, as we know Amazon at least is planning to reduce their staff a little bit more. So here you can just see the year-to-date chart of layoffs. Here you can see November is the peak so far in employees laid off totally in the tech industry. And so we'll see as we go into December, into the new year, if these layoffs continue as rapidly. Hopefully not. Definitely will be interesting to see though. As always, here at Synergy Asset Management, we're always watching the news about PPI and retail sales and retail earnings and tech layoffs and everything we need to know. We're always monitoring for you and using these economic updates to best monitor and manage each portfolio per its mandate and its nature to best take care of you, our clients. Thank you so much for tuning into this week's Manager's Thoughts, and we look forward to providing another update next week.